What if I told you that many billionaires don't get richer by spending their own money? Instead, they often use borrowed money. Sounds crazy, right? Most people are taught that debt is dangerous and should be avoided at all costs. Yet some of the wealthiest people in the world use debt strategically to build even more wealth. Today, we're going to break down how billionaires use credit, leverage, and assets to grow their fortunes, and why understanding this concept could completely change the way you think about money. Chapter 1. The biggest myth about billionaires. Most people imagine a billionaire sitting on a giant pile of cash. But that's not how wealth works. Let's say someone has a net worth of $1 billion. They probably don't have $1 billion sitting in a bank account. Instead, their wealth is usually tied up in assets, such as company shares, real estate, factories, investments, businesses, intellectual property. These assets can increase in value over time, and that's where the real wealth building begins. Because billionaires don't just own assets, they use those assets as financial tools. Chapter 2. How the rich borrow without selling. Imagine you own stock worth $100 million. You want $10 million to invest in a new opportunity. Most people would sell part of their stock. But many wealthy investors do something different. They go to a bank and say, "Look, I own $100 million worth of assets." The bank agrees to lend them $10 million using those assets as collateral. Now they have cash without selling their investments. Why is this powerful? Because they still own the original assets. Let's assume assets $100 million, loan $10 million, annual asset growth 15%. 1 year later, the assets are now worth $115 million. That's $15 million in growth. Meanwhile, the loan interest might only cost a fraction of that amount. The billionaire keeps most of the upside while using borrowed money. This strategy is often called borrow against assets. It's one of the most powerful tools in modern finance.
Chapter 3. The power of leverage. Now, let's talk about leverage. Leverage simply means using borrowed money to control more assets than you could with your own cash alone. Imagine two investors. Investor A has $1 million. Investor B also has $1 million. Investor A buys $1 million worth of assets. Investor B invests his $1 million and borrows an additional $4 million. Now, Investor B controls $5 million worth of assets. Suppose the assets increase by 20%. Investor A, $1 million becomes $1.2 million. Profit equals $200,000. Investor B, $5 million becomes $6 million. Debt remains $4 million. Equity becomes $2 million. Profit equals $1 million. Same market, same investment, but leverage multiplied the return. This is why real estate investors, private equity firms, and major corporations frequently use debt. Debt acts like a financial amplifier. When things go right, the gains become much larger. But there's another side to the story.
Chapter 4. The dangerous side of debt. What happens when investments go down instead of up? Let's revisit Investor B. He controls $5 million worth of assets using $1 million of his own money and $4 million of borrowed money. Now imagine those assets fall by 20%. The $5 million investment is now worth $4 million, but the debt is still $4 million. His entire $1 million equity has been wiped out. That's the danger of leverage. Debt can multiply gains, but it can also multiply losses. Many investors and businesses have gone bankrupt because they borrowed too aggressively. The smartest investors don't just focus on making money, they focus on managing risk. Chapter 5. How companies use debt to grow faster. This principle applies to businesses too. Imagine a company that consistently earns 15% returns on expansion projects. A bank offers financing at 8% interest.
The company borrows money, uses that money to expand, and earns a higher return than the cost of borrowing. That difference creates value. This is how businesses build factories, open new locations, acquire competitors, expand internationally, invest in technology. Many of the world's largest companies carry billions of dollars in debt, not because they're struggling, because they're strategically using capital to grow faster.
Chapter 6: The tax advantage of borrowing over selling assets. There's another reason wealthy people often prefer borrowing over selling assets: taxes. Imagine a billionaire owns stock that has grown from $10 million to $100 million. If they sell those shares, they may owe millions in capital gains taxes. But if they borrow against those shares instead, they get cash without triggering a taxable sale. In many countries, loans are not considered income. That means they can access liquidity while keeping their investments intact. This strategy is sometimes described as buy, borrow, hold. The asset continues growing, the owner gets spending power, and taxes can often be delayed for years. This doesn't mean taxes disappear, but it can significantly improve long-term wealth accumulation. Chapter 7: Why banks love lending to the rich? You might wonder, why would a bank lend millions or even billions of dollars to wealthy people? The answer is simple: risk. Banks don't like lending to people with uncertain income. They prefer lending to people who own valuable assets. If a billionaire owns hundreds of millions in stock, real estate, or businesses, the bank has collateral. That makes the loan much safer. In many cases, wealthy borrowers can access lower interest rates than ordinary consumers. Ironically, the people who need money the least often get the cheapest loans, because lenders trust assets more than promises. So the next time you hear that a billionaire borrowed millions of dollars, don't assume they're in financial trouble. Often, they're doing the exact opposite. They're using debt as a tool. They're using assets as collateral. They're protecting ownership, they're optimizing taxes, and they're allowing their wealth-generating machine to keep running. The biggest lesson isn't that debt makes people rich. The lesson is that assets make people rich. And debt, when used wisely, can help those assets grow even faster. Because the wealthy don't just think about earning money. They think about controlling assets, controlling capital, and controlling opportunities. And once you understand that difference, you'll never look at money the same way again. Thank you so much for watching. If you find the video valuable, you can check other content from us too. And don't forget to like, share, and subscribe. See you in next video. Until then, keep learning and growing.